Welcome to the Deep Dive. Our mission today is pretty laser-focused. We are diving deep into the sources around U.S. inflation trends and the policy challenges that are really defining 2025. If you've been following the news at all, you know the easy part of this inflation fight is already over. And this is so critical for you because inflation isn't just a temporary shock anymore. It's become a structural factor that impacts every single financial decision you make, right? From mortgage rates all the way down to the price of eggs. We're here to give you the shortcut to really explain the core drivers and how policymakers are trying to react in this really complex atmosphere of uncertainty.
That's exactly right. We're trying to move past that surface level discussion. The whole point is distillation. We need to pinpoint the specific price pressures that are just remaining stubbornly high and then detail the unique operational headaches facing the Federal Reserve as they try to navigate the path forward.
Okay, let's unpack that. Let's just jump right into the current inflation landscape. For our listeners who want to get past the headlines and understand the levers that are actually moving prices, where do we stand right now? Which sectors are proving to be the most resistant to cooling down?
Well, the sources are pretty much unanimous here. The persistence is centered in costs that, consumers simply cannot avoid.
The non-discretionary stuff.
Exactly. While the overall rate has slowed from its peak, the price level is still elevated, and the upward momentum is really concentrated in what we've been calling the stubborn triad.
The stubborn triad, okay.
Yeah, we're talking about three specific sectors causing immense upward pressure. First, you have food costs. These are affected by, everything from global commodity markets to local weather patterns. It's incredibly complex.
Right.
Second is energy. Even, these modest spikes in oil or natural gas, they just translate so quickly into higher costs for transport and manufacturing across the entire economy. But the stickiest factor, and the one that resists policy fixes the most, is housing. This component is measured mainly through rent and something called owner equivalent rent, or OER.
Okay, hold on. Let's pause right there for a second on OER. We know our listeners are well informed, but OER, it trips a lot of people up. Can you just quickly clarify what that is and why it makes inflation so sticky?
Certainly. So owner equivalent rent is basically an attempt by the Bureau of Labor Statistics to estimate how much a homeowner would pay to rent their own home.
So it's a hypothetical number.
It's a purely imputed cost, yes, but it makes up a massive percentage of the overall consumer price index. We're talking often around 25 to 30%. It's huge. And it's sticky because of the long lag effect. Real-world lease contracts, they're signed for 12 months, right? So when we see market rents rising, those changes can take many months, sometimes even up to a year, to fully filter into the official inflation statistics.
Wow.
So even if the housing market cooled off today, those high OER readings from previous months are going to keep inflating the CPI for a long, long time. It's essentially a time bomb built right into the data.
That structural reality is it really underscores why fighting inflation feels like pushing against a rising tide for the average person. When you realize those three things, food, energy, housing, are the core of the budget for almost every family, you understand why financial stress stays so high, even when you hear headlines about things cooling down elsewhere.
Precisely. And that lack of immediate relief feeds directly into the public's inflation psychology, which, as we'll get into later, is a huge policy factor in and of itself.
That complexity leads us perfectly into the next challenge, the policy headwinds. The things complicating the job for the Federal Reserve. We touched on this idea that policy is only as good as the data it relies on, and this is where one of the source's most surprising details comes out. The disruption from the recent government shutdown.
Yeah, that was a big deal.
It wasn't just an inconvenience, was it? The shutdown actually affected the release of crucial economic data.
Yeah.
Meaning the Fed is flying the plane. This is like losing your radar in a dense storm. What specific reports went missing, and why did that force the Fed's hand?
What's fascinating here is that the Fed has its preferred measures. For inflation, they rely heavily on the Personal Consumption Expenditures Index, the PCE. They see it as a more accurate indicator than the more famous CPI. So when a government shutdown hits, the release of crucial reports like the PCE, but also certain employment figures and key manufacturing reports, it all gets delayed, sometimes stalled entirely. The immediate implication, policy-wise, is that the Fed loses its ability to see the recent past clearly. They need high-frequency, reliable data to confirm or deny trends before they go and set the federal funds rate.
So without the latest PCE number, what do they do?
Well, they have to lean far more heavily on lagged indicators, anecdotal evidence, or, potentially less reliable private sector forecasts.
So they're being asked to make these massive economy-altering decisions based on incomplete information. It just seems to raise the risk of, over-tightening or maybe easing too soon?
Exactly. This lack of clear reporting complicates the whole policy environment because it dramatically reduces visibility and it increases market volatility because the raters hate uncertainty too.
Yeah.
They start making larger, more speculative moves based on rumors or incomplete data, which then further stresses the very system the Fed is trying to stabilize. So the absence of data, it creates its own kind of instability.
That sets the stage perfectly for this extraordinary balancing act the Fed is performing. They have that dual mandate, stable prices and maximum employment. With the data so murky and these structural costs so high, just describe the sheer tightness of that tightrope walk for us.
It's maybe the most difficult challenge the Fed has faced in decades. They have to achieve this strict inflation control, getting prices back towards their target, but without triggering a sharp economic downturn or doing severe damage to the labor market. And the tools they have, like raising interest rates, they're blunt instruments. They affect both things at the same time.
Okay, but wait a minute. If energy is such a key input cost, and we saw some recent dips in global oil prices, shouldn't that expected cooling be factored in by now? Why do the sources still suggest the Fed is worried about persistent momentum?
That is a crucial distinction. While headline energy prices might dip for a moment, the Fed is much more concerned with core inflation and, maybe more importantly, future expectations.
Okay.
Those dips in oil don't immediately fix the underlying cost pressures in food and housing, which are driven by really complex internal factors like labor costs or supply bottlenecks. And on top of that, the real concern is that if the Fed eases up too early because of a temporary oil dip, they risk unanchoring inflation expectations.
Unanchoring expectations. Let's break that down.
This is where it gets a little technical, but it's absolutely vital. Unanchored expectations just means that consumers and businesses stop believing the Fed will actually bring inflation down to its target. And if a business expects costs to rise by, say, 5% next year, they're going to raise their prices by 5% today.
And their workers will demand higher wages to compensate for that.
Exactly. And that feedback loop locks in high inflation no matter what real-time energy prices are doing. So the Fed isn't just fighting current prices, they are aggressively managing the public psychology and their beliefs about the future.
And managing belief is a very hard job when your own data stream is spotty. The whole system just becomes incredibly vulnerable to market sentiment. So we have this rising, persistent pressure from essential sectors, the unique difficulty of missing data reports, and then this need to manage public conviction. It's an almost impossible set of constraints.
Let's shift gears for our final segment. Let's focus on the outlook. What should you, our listener, be watching for in the coming months? Are the sources pointing toward relief, or should people be preparing for ongoing financial headwinds?
The outlook, based on the current analysis, really dictates continued vigilance.
Yeah.
We are not seeing strong signals that the core pressures, especially in services, housing, and food inputs, are going to abate dramatically in the near term.
So more the same for now. For now, yes. The policy moves we can expect, whether they are, adjustments to the federal funds rate or maybe just stronger forward guidance, they will remain very responsive to the risks of inflation reaccelerating. For businesses, this just means inflation continues to be a defining factor in investment and pricing strategies. Companies have to keep factoring in higher input costs and a tight labor market. And for families, the practical impact is that budgeting for food and energy, even with the volatility, it just requires more conservative planning. The critical point here is that inflation is still the dominant narrative. We just can't afford to treat it like a solved problem. The source material is clear. The fight has entered a really grinding, persistent phase where the gains are slow and very hard won.
That provides some really crucial clarity. Okay, let's synthesize the key takeaways. First, the structural inflation story is really defined by that sticky triad.
Yeah.
Food, energy, and especially housing, because of that embedded OER lag.
That's number one.
Second, setting policy has been specifically complicated by the government shutdown and the disruption to those key reports. It's forcing the Fed to operate with blind spots and elevated risk.
Right.
And finally, the Federal Reserve is walking this knife's edge, fighting not just current costs, but the danger of unanchored expectations. The public's belief about future prices, which, if they lose that, could lock in higher inflation for years to come.
And knowledge is most valuable when it's understood and applied,
Right.
which raises a really important question that builds on everything we've talked about.
Indeed. So here is our final thought for you to mull over. Given that the sources all point toward ongoing, persistent price pressures, particularly in those non-discretionary categories like food and energy, what immediate tactical adjustments should you be making to your personal financial strategy? I mean, beyond just generic saving, to specifically insulate your household from the rising operational costs of daily life. Think that one over. Thank you for joining us for this essential deep dive into the U.S. inflation challenges of 2025. Stay informed, and we'll catch you next time.